Good afternoon. Welcome to LBMA webinars. Today we will be discussing OTC trading in the year of the pandemic. We have Adrian Ash, BullionVault, David Gornall, LBMA Senior Advisor, and Fergal O'Connor, Cork University Business School. I will leave the proper introductions to our host, Adrian Ash, when I hand over to him. But before I do so, I just want to remind you that if you have questions throughout the webinar, please use the Q&A function at the bottom of your screen to submit these, and we've got some time allocated at the end of the webinar with which we can address these. Without further ado, Adrian, whenever you're ready.
Thank you very much, Taylor. Well, good evening, good afternoon, and good morning to all of our friends and colleagues around the world. I hope you are well this new year. 2020 was obviously a dreadful year, and even aside from the death and destruction, it was clearly very dramatic in financial markets. We had the Dow Jones's worst day since Black Monday of 1987, followed by record highs in US stock markets, record IPOs, $1 trillion valuations on Apple and Amazon, Tesla trading at 30 times sales. We had negative oil prices, and new record lows in treasury yields, and the worst global GDP crash since, well, the end of the Second World War, plus historic government deficits and QE. We also had a record gold price in our own market, of course, and phenomenal volatility in silver and the PGMs. Gold itself had the steepest volatility since 2013, the year of its big crash, although it was still only 3/5 as volatile as the US stock market and barely 1/5 as volatile as natural gas. So what was happening under the hood? The LBMA Trade Data, collated from members such as BullionVault of the LBMA from the trades that they make on behalf of their clients each day, helps us look into this. And to help us dig into the numbers today, we are joined by David Gornall, formerly of Natixis and also former chairman of the LBMA and our senior advisor, and also Dr. Fergal O'Connor, lecturer in finance at Cork University Business School. So if we start with our top line, Taylor, do I have control of the slides? There we are. Thank you. This basically shows you the full series of total gold volumes through LBMA members since the project first began in November of 2018. And you can see over here is the daily volume. So here we have a spike just as gold was reaching its high of almost above $2,000 an ounce back in August of last year of almost 90 million ounces. So you're looking at about $180 billion worth of value changing hands in that one day. So if we roll back to late 2019, we can see where the volumes were there and really running through. David, do you want to talk us through just, what was happening in the year here? So, looking at the numbers from really coming into November and then into the new year here. I mean, obviously we've got there the March crash, look, and you can see that there's quite a lot of volume there going through, look. What are your thoughts about, what this second half of the chart tells us?
Yeah, thanks, Adrian. So first of all, just to give you a bit of background on what this chart is, as Adrian said, this is the daily chart. And this is a total of all of the sub-asset classes. So it includes the spot trades, the forward trades, the option trades, and the lease loans. And the forwards are quite interesting, and they'll become apparent when we talk about this chart in particular. So I think what it's telling us here, and we don't normally look at volume, and we, as you can see, we only started this in 2018. From the point of March, where we see these volumes increase, we can see that the stabilization of the volume, you can see it's between 20 and 40 million ounces on average. The spikes, when we look into them, are a manifestation of larger forward volumes. And that becomes quite excessive when we get to the large price spike that you can see there, where we hit that number just under 90 million. I think there was 89.4 million ounces in total. But digging into that, what we normally see, just to give you the scope and the scale of this, is on average about 20 million ounces of spot, 10 million ounces of forwards, and let's say about 1 million ounces of options and lease loans. What we saw on this particular day, where it spiked at the end of July, were forward trades that were probably in the area of, I think that's 60 odd million ounces.
Yeah.
Is that right, Fergal? Yeah. So 20 million ounces of spot was the norm. The excess came from the forwards, and I think this was really tracking back to what happened in March. If any of you were listening to the last webinar, we talked about the price disconnect, and then we drilled into the volume and what that told us. And it seemed to show us that there was a lot of switching from futures selling towards the OTC forward selling. And this chart, where it spikes, actually tells you that that's the case. So towards the end of the year, we've got the Pfizer announcement, the Pfizer day, and I think we're going to go into a bit more detail on that later on in this webinar. And then right at the end of the year, there is a dip. And in fact, looking at those dips, nothing unusual about any of those at all, where they're sub 20 million. The first one was the Maybank holiday, and then we're followed by 2 Christmas periods.
It's Christmas Eve and New Year's Eve are the 2 really low ones right at the end.
Those are the ones,
right.
Yeah. But I think what we're trying to show you there is that what happened with the price, the rally, the disconnect, the COVID day, and the Pfizer day, the volumes have broadly stayed within a range that we would expect.
Okay, thanks, David. Moving on, if I can, there we are. So just to put the OTC, the over-the-counter market, primarily traded through London, in context, we're looking here against the CME, so the New York-based futures derivatives exchange, where obviously it is contracts that are being traded, the futures market. And David, you suggest that the best comparison really to look at CME futures against the spot and forward swap on OTC. That's as close to like for like, effectively.
It is, yeah. A couple of the journalists got in touch after the last webinar saying, I really can't find these numbers. I think this is part of our grand plan. We want you to dig into them, and the way we condense the first chart, probably, you know, we want you to be a little bit investigative and start looking at these things in greater detail. So we're giving you the flavour and a bit of background to lead you down the way. But yeah, as you can see, when we first started to produce the data in late 19 was a full year, and we could see clearly that the gap between CME and OTC was about 4 million ounces there. And so again, just to explain what we've done to compare like for like, we've only taken the CME futures and taken what would be the equivalent of OTC. So that's a mixture of spot and forwards and swaps. And we haven't, as we did in the first chart, include the options or the leases, because that wouldn't be a fair like for like comparison.
Yeah. So looking at actual, you know, the spot versus the spot and forwards versus futures, then, I mean, what I think is interesting on this is that if you actually look at, so David and I spoke on the webinar back in May about the big price disconnect that you saw. So when the UK went into its first lockdown on March 23rd last year, the New York front month price woke up the following morning at $100 premium. Basically, the assumption by a lot of speculators was that gold would not be able to get across the Atlantic from London, the central hub, into New York for delivery against COMEX futures. And basically the big gap of $100, which is phenomenal. And it's an absurd number by any measure. That speculation actually proved unfounded, because the logistics industry managed to ship in record quantities of gold into New York despite lockdown. Air freight was still moving. But what's interesting is that even whilst that arm was closed, you still had what David and I observed back in the May webinar, that there was this shift towards London. Now, if you look at what's happened so far in 2020, and this chart basically takes data compiled by our friends at the World Gold Council, you can see that London and CME are pretty much the same. I mean, you know, they're not so much competing as kind of complementary, if you like. But London did expand last year at the expense of COMEX volumes. What I find really interesting is if you sum 2019 and you sum 2020, they both come out at the same number. You know, in terms of total aggregate volumes being traded across both markets, there was no different last year. What you can also see, obviously, is that together, London and New York do dominate globally. I mean, I think it's important to note that the Tokyo Token is in there, it's in others. I mean, that's how small Shanghai Gold Exchange, Shanghai Futures Exchange, ETF, gold-backed ETF volumes coming in around 2% of the total, according to the World Gold Council data. So as I say, I think what's interesting here is that, they are kind of complementary. We did see this shift last year in weight towards London. So looking at our next chart.
And just in terms of scale, then outside of the precious metals, that daily number for London alone is the same as UK gilts. So the average daily volume for UK gilts is almost exactly 33. It's a similar value.
Right. Okay. But there's 176 different gilts trading.
Yeah. So it's obviously, in terms of liquidity, it's broken up, but the size of the London spot market for gold is roughly the same daily as the size of the UK gilt market. So that just gives a sense of scale in terms of other asset classes then.
Okay, thanks, Fergal. What this chart, I mean, just looking at the London-New York kind of move across last year, the chart here basically is taking London OTC volumes, again, spot and forwards versus futures, as a percentage of New York market. So, I mean, the scale is kind of irrelevant in a way. What's important is if you're above the line, London is larger. If you're below the line, this is daily data, then New York is larger. And what I find interesting here, and again, this really speaks to the shift that we saw around the big disconnect, around the UK lockdown in late March, was that over the first 60 trading days of 2020, London was larger on only 12. You then had a run of 27 days unbroken where London was larger. And then this kind of assertion of London, if you like, marginally, but nonetheless, it's still there. That then really continued throughout the second half as well. So you can see that where New York is larger, that's below the line. Where London is larger, that's above. What's also interesting, I think, is if you look at these peaks, and particularly where New York takes the lead again. So this is July, really interesting, this period here where New York is larger. Well, that's where gold was really starting to accelerate towards its peak at 2000. That is the big forwards that David mentioned earlier, coming through in the London market, whether that was producer hedging, whether that was banks hedging, whatever. The OTC data doesn't tell us that, but I think certainly we can see that, there was a huge shift because prices have been driven so much higher by this speculative activity on the COMEX here. Similarly, this is Pfizer Day. Okay, so this is the 9th of November last year when Pfizer announced that it had successful trials of its vaccine for COVID, thank heavens, and gold dropped $100. Well, London was half the size of New York volume that day. So I think it's interesting to see that where gold was really bullish, COMEX was leading. Where gold was spiked lower, COMEX was also leading. So, look, I mean, across the year, obviously, we had record OTC volumes. We also had record price, preceded by the crash in March, alongside everything else, recovery, the surge, the big retreat. So what does that mean for liquidity? Because obviously looking at volume is one thing, but really what matters for investors is, how able am I to sell when I want to get out of an asset? Now, famously, Barton Biggs, hedge fund manager, said that liquidity is a coward because it disappears at the first sign of trouble. Now, is that true for precious metals? Is that true for gold and, for the other precious metals? So to look at that, Fergal, can you drill down for us, particularly on, so this is the COVID crash. So this is, really when the world was suddenly realizing that this thing really was happening and it really was coming.
Yeah, so we got some nice natural experiments in the data this year. The data, we haven't had the data very long, but we had some big events that allowed us to kind of see what happens within the data when big moves happen. So the first one was obviously, we took the period the 20th of February, 23rd of March, because that's the period that the S&P was falling through. So all through this period, the S&P was dropping. And you can see the gold price is obviously the yellow line, and it holds up pretty well. It drops off towards the end. But what you can see with the volumes is the volumes are very high. The average daily volume for London is about 33 million ounces. And you can see that there's no day during the COVID crash period. So when gold is doing what gold should be doing when markets are crashing, offering liquidity, offering safe haven, there's no period where where the volume drops below the average. So it was very liquid all through this period, whether prices were holding up or prices were dropping. as they did towards the end of it, liquidity was really strong. So we'll see later on kind of the average liquidity that we can see over time. But like you said, liquidity is only useful if it's there when things go wrong. And this year anyway, when things went very badly wrong for equity markets, gold did what it should do. It still provided liquidity. It looks like there's a big drop off there around the 4th of March in terms of liquidity, but it's still above average liquidity for the gold market. So all the way through, anyone, it looks like people who wanted to buy, people who wanted to sell, were able to.
Yeah, David, I mean, what are your thoughts on, what this chart is showing us, particularly around the COVID crash here?
I'd agree with Fergal. Originally, I thought that there was some concern about liquidity, but it's fair to say that it should be explained by looking at other asset classes, which I think we might have a little go at doing.
Well, you've got, this is the 12th, which I think was the steepest fall in New York equities since Black Monday '87. I think the S&P closed the day 10% down. So I guess, the point here is if you were getting a margin call on your equity positions and you wanted to sell your liquid gold position, well, you could.
Well, it's one thing that we try and talk about in terms of the qualitative side of the gold argument. And when we talk about liquidity, what we talk about in gold more often than any other asset class is the correlation with price and need to sell, which is exactly that scenario that you mentioned there, Adrian. We saw that effect where margin calls were being made in other asset classes. And in an unhedged portfolio, when you're selling gold to generate those margin calls, you're selling into a rising market.
Yeah.
So the most effective way of balancing the portfolio when we get the dislocations and we get the liquidity problems in other markets. So gold really proved its worth in this example.
Well, I think that's an interesting point because in terms of gold relative to the other precious metals, how do we think about, gold versus silver and platinum and palladium? And Fergal, this is a chart from Fergal, which I think is really interesting. Fergal, do you want to talk us through what this is showing us?
Yeah, so this is from a paper I'm writing with Professor Brian Lucy, who does a lot of stuff with the LBMA as well, and Professor Shane. So we got the data with thanks to the LBMA and NASDAQ. They gave us the data before Christmas. We started working on it. And what we were trying to work out is how the markets interact with each other. So, we have gold, silver, platinum, palladium, and we have the volume data. So what this chart shows is basically which market is leading, right? So which is the leading market. And if you look at the chart up to January 2020, because it's negative, this is saying that the other metals are driving the gold price a little bit, right? So the gold price is not dominant. They tend to move first almost, right? So they're the movers first. But what you see then as you move towards once we get to February, March, April, when COVID's kicking in and people are buying gold and prices are rising and you've got a safe haven effect, is gold becomes almost completely dominant, right? So the numbers on the axis don't mean an awful lot. They're just a relative scale, but you can see it goes from around 1 or -1 for a long time. It goes all the way up to 4. Gold becomes incredibly dominant and starts to lead everything else, and that's the safe haven kind of action of gold again coming into it. This is kind of a 200-day moving average. You can think of it like that. So as it's rising, that's because it's gold is continually every day showing that it's the leading metal going through it. So this is the total volume. And we can see that we've drilled down then into the various categories as well. And even within the categories, gold is becomes dominant in March, April when it needs to be, right? So obviously,
in terms of different instruments. So in terms of spot.
Yeah. So this is total. This is spot. Sorry, this is
right.
Spot. If you look at total spot lease, there is this big change around the time of the COVID crash. And that's what you'd expect gold to do, right? You wouldn't. It doesn't need to be the dominant metal when things are perfectly nice and floating along, and everything's economic growth. It's when there's some sort of a market crash or a panic to something like COVID that's when you would expect gold to kick in and be the first mover. The money is going towards gold first. The volume is happening there, so it just confirms
that dominance becomes very stable as well. And in the back half of the year, this is obviously it retreats, but this is such a strong period of dominance, if you like.
Yeah. So it continues on. So it'll be interesting to see how that develops over time. So obviously we've only got data from late 2018. So the longer this goes on, the more we can say about it. But these are the things that getting the data produced will allow so much more digging into what's happening within the market. We haven't done it yet, but we'll be linking it up and seeing how it's linking with the CME and things like that. Because previously they look pretty balanced in terms of which market dominates when you look at the price action. New York and London are pretty equal partners, taking the lead at different times. But when we see the volume now, it'll be interesting to see how that affects the picture.
Okay, great. Now, I mean, in terms of gold liquidity, we looked at that in terms of the COVID crash and looking at, when other assets were falling, gold was deeply liquid and it was available. But I mean, looking at the Pfizer announcement again, as we mentioned, November the 9th, gold lost $100 on the day pretty much. And I think the stock market jumped to new record all-time highs on the news that Pfizer had come out with something which had passed its trials and was basically set for regulatory approval. So this is when the crisis, if you like, came just for gold rather than for the broader financial markets. So Fergal, what are your thoughts on this period?
That was so you kind of have two very different, in fact, you have three natural experiments because you have the all-time high as well in price.
Yes.
There's one where another market is crashing. What happens to liquidity? And gold does very well. This is when the gold price is dropping. So I think you said it's the biggest one-day fall since the 70s, Adrian. I think you said that to me.
It was like 4.6% that day. I think it was 78. I think 78. Yeah, 1978, I believe.
So that's a significant, right? It's a really significant day for the gold price. And obviously, so the volumes here are not as high as they were during COVID, right? So during the COVID period, we were above 35 million ounces every single day. But you can still see that the volumes are quite decent. So if you draw a line there, kind of 33 million ounces, the average through that period is still around the 33 million ounces. And it never, the standard deviation is about 8 million. So it's within one standard deviation all the way through. There's one very low point, obviously, in the later half of the graph, but I think we checked yesterday, and that is Thanksgiving, isn't it? To the November date where it's below 25 million ounces. So I mean, it remains liquid. It is less liquid, but it's still. I mean, when you compare it to other markets, that's still an awful lot of volume flowing through on that day, and there isn't an enormous spike in selling or an enormous drop off in the ability to buy or sell, even when the price is going through its worst day, since the 70s. So again, the market seems to pass another stress test in terms of liquidity there. People seem to be able to buy and sell their gold as they want. So, you have a stress test coming from the stock market, then you have an internal stress test where gold's own price is falling, and then there's another chart looking at the all-time high, and again the volumes are fine there. We have a record day for volume that David already pointed out, driven by forward activity, but there really isn't a collapse in the volume of trading, even with an enormous fall in price. So
well, again, I think on the next slide, if we can go to the next slide, this is the Amihud ratio. Now, I think it's an interesting number. Can you run this through for us, Fergal, in terms of what it is we're looking at here? What does this tell us?
So Amihud is the measure that the EBA were using when they were looking at
European Banking Authority.
It was one they highlighted. It was missing for gold. It was 2016, I think. That's there now. What the Amihud measures is how much does price move for every dollar of volume moving. So a more liquid market has a smaller number, right? So if the price moves a dollar for every $1 million of trading, you divide the two, and that's where you come up with the Amihud measure. And so this is the daily measure. If you take, I can't remember what the average is, but if you look at the chart on the numbers on the left, they're incredibly small. They're a very small number, and if you compare it to what the EBA and others have had for other markets, it's actually an order of magnitude smaller. It's multiples smaller than maybe corporate bonds and things like that. I think it links back to
what have we got here for this? This is the March crash across all markets, and obviously gold is relative to itself a little bit more illiquid. So this is illiquidity go up, right? It's a bit more illiquid. But how does that compare to other assets?
It's still much more liquid than it. So the other assets that I've seen from studies have Amihuds of about 0.01, and you can see that this is 0.0001. So it's still significantly smaller. And look, I think the reason for that is what we said earlier. So the spot market is a similar scale to something like the UK gilt market on a daily basis. But when I had a quick check a couple of weeks ago to get a bit of an idea of this, why this number was so much smaller, I found about 167 gilts trading in London. So obviously that I think it's $33 billion a day that gets traded in gilts. That's divided, into 167 individual parcels of liquidity, whereas this spot market is just one. So it's an incredibly, I suppose in one way, it's an incredibly concentrated market, right? It's mostly in spot on most days, but that does make it much more liquid. Okay,
thank you. Just before we go to questions, I mean, obviously you guys spend a lot of time looking at this data, and I think the project as a whole is clearly very, very helpful. Just in terms of any tidbits, any insights that you've got or any big takeaways? I mean, for me, I think looking at the data with you guys this week ahead of today's webinar, for me, it's that, New York and London are pretty much equal in terms of volume size, but one will take over at different times. London, particularly during the March crisis, but then New York in terms of speculative activity coming through July up to the big peak in August, and then again on the Pfizer drop. I just think it's really, really useful to know that from an analytical and definitely from a trading point of view. David, what would you say is your key takeaway?
Well, I think we're learning all the time. This is a new data set, isn't it? Starting in January 19. And it was fair to say that gold and the rest of the precious metals trade data did need illuminating. And we were trying to catch up with other asset classes that were demonstrating that they were liquid in terms of the argument regarding the qualities of a high quality liquid asset. And that's why we started to produce this data, and therefore we could come out with the AMIHUD. And I think, yeah, we're still learning these things. When I first looked at it, it looked very, very strange to me. We do get the benefit of having this chart produced, the AMIHUD chart produced in euros, which is what the EBA asked us to do. So we do get a pickup on the negative correlation with the dollar there. And also it's a daily figure, it's not an intraday figure. So as we're expanding and enhancing, we hope to make it better. But yeah, you say the tidbits. I mean, we were looking, was it last Thursday? And again, we saw a spot number of 7 million ounces in there. But the total number was 32 million ounces. And again, when we dug into it, it was 25 million ounces of forwards. So yeah, we didn't really understand why until we looked at the date and saw it was 2 days before Martin Luther King Day. And then we asked NASDAQ to have a look, and they said, yeah, we spotted that as well. And it happened last year. So yeah, it's a new data set. We're learning new things.
So basically there's extra dealing through London a couple of days ahead of Martin Luther King Day because New York's going to be shut.
So where do the futures guys go when the futures market's closed?
Okay. That's fantastic little insight. Fergal, what about you? I mean, you put these two charts for us.
Yeah, it's just
really nice.
Yeah, playing with the numbers and just seeing. So, I mean, one of the things the liquidity will tell people maybe is when they should be, if you have a large trade to place, when should you be placing it, right? So I haven't looked at during the year yet. We don't really have enough data to look at which month is the most liquid because we only have 2 years really. But you can see the middle of the week, and it's unsurprising. Like the middle of the week is more liquid.
You have
pretty much every asset class. Usually Wednesday would not, it's not massively more. So Tuesday, Wednesday, Thursday are heavier days. Monday and Friday are smaller. The first chart maybe, because it doesn't start at zero, maybe overestimates the difference. They're not massively more liquid or less liquid. You're talking about 4 million ounces or 3.5 million ounces, I suppose. But definitely there is a day of the week effect there. There's a pattern that, and maybe market participants already know this, and that's why it's happening, that there's more liquidity in the middle of the week. And I think now that we have the data, there's an awful lot more you can do with it. And there's more richness coming as well. So there's the VIPT price data, which will break down the daily volume between the prices that it's being traded at. So I started looking at that. The NASDAQ have given me that data to look at. So we can look at how the liquidity spreads out during the day. And even from, I haven't done much on it yet, but you can see some days the liquidity is quite broad across a range of prices. Other days it's very bunched together in the middle. So there's a lot more to be done there. And that's there for leases, forwards, spot across the different things. And I mean, I suppose the most surprising thing to me was how liquid the market was. I mean, I think, David, back when you started working with the data.
That's not what you said originally.
Yeah, you emailed it to me.
Didn't make any sense at all, so I sent it to you, didn't I?
Yeah, and I thought the number was ridiculously small as well. I went looking at it, and I think I did find a tiny error in the code, and I made it smaller again. So, it's, you know, it is surprisingly small. It does make sense when you compare it to the fact that the other assets are, you know, particularly bonds, because they're assets that have different maturities, whereas obviously there's only one spot. It's much more fractured liquidity, right? Whereas spot is just very deep, and, you know, everything flows through spot. So, for, you know, if you enter a forward contract, someone has to buy its spot to give it to you at some point, right? Unless it comes from a miner. So it makes sense that there's so much concentration there in the spot market.
Okay. Right, I think, should we go to Q&A? Taylor, if you want to bring up the slide there. Certainly one that we've had coming in is one, David. In terms of, you know, if I'm trading bullion, you know, maybe if I'm running a bullion desk, I mean, how important really is this new data set? If I'm already looking at CME volumes, aren't the two throughout the day actually kind of coincidental? So that, you know, if I'm looking at what the COMEX is saying about volume, do I really need to know what the London market is also doing?
Yes, you do, for several reasons. I think because we've got a split of different asset classes, it's telling us different things about the market. And certainly our anecdotes about the spot and the forwards are very good examples of that. Because if you just look at the top line and say, oh, it's another 30 million, when you drill down, you'll find different stories. I mean, there's a couple of days in there where you'll see the average lease trades that we see about 1.5 million ounces, top 2 million ounces. So if you are running a trading book combined with that analysis that Fergal just gave, you really need to know when the best time is to trade. You're trying to find out when the market is the most deep and liquid and arguably more efficient. So as a trader, it's a tool that you must have.
And I presume the same is true for the other metals as well, right? I mean, we haven't looked in detail at silver or the PGMs today. But I mean, obviously in the work that you've been doing recently, David, is there anything that, you know, from 2020, is there anything that stands out for you in the other three major precious metals?
Well, I think that we've been talking more about the white metals, and certainly in silver. We didn't look at the silver amihud, for example, but that liquidity is becoming quite constant. So I don't know that we saw such dramatic divergences in the silver from the data we were looking at. In the PGMs, we can see a large spread of different trades. I mean, the ratio between the loans and the spot on platinum is a lot. I'd say that it's geared more towards the loans on the platinum side than it is, say, for example, on the gold side. Okay. So is that a consequence of AutoCAT financing? So this data gives you a lot of chances to start to inquire where daily liquidity actually goes in all four metals.
Okay, thank you, David. Well, I think that's pretty much all from us for today. So Taylor, thank you. So obviously, if you want to access the data, it is available on the Bloomberg terminals. You can also speak to NASDAQ, who compile the data on behalf of LBMA and its membership each day. So if you haven't had a chance to look at the data, please do. I think it's clearly becoming a very, very important part of understanding our market and its further development there. So just to say thank you very much, David. Thank you very much, Fergal. And Taylor, back to you.
Thank you very much. And thank you again, Fergal, Adrian and David, for joining us. LBMA is very grateful to have you on board. For our audience, if you did have any questions today but weren't able to put them forward, I did see somebody had raised a hand but didn't submit a question into the Q&A function, just email us at ask@lbma.org.uk so we can send these across to Fergal, Adrian and David. I'm sure they'd be more than happy to answer any questions. As for housekeeping, I know at the end of the last webinar, I did promise you a webinar on the 28th of January, but I told a minor fib. What we'll be doing moving forward in 2021 is we will be doing bi-weekly webinars. So starting from today, our next webinar will be on the 4th of February, and then following this on the 28th of February. So we'll have Chinese New Year on the 4th. We've got Jeremy East and Joni Tevez so far. We are waiting on one more panelist, but I can assure you it will be a very good panelist. And on the 28th, we do have the LBMA price forecast. So we'll be announcing the winners from the previous one and kind of speaking more about 2020. Obviously, as it's a price forecast. So just as a heads up for any people who did participate in the webinars last year, they are CPD accredited. So please email events@lbma.org.uk if you do want to receive a certificate for attending the live webinars. We'd be more than happy to send one over for you. And lastly from me, please follow us on social media so you can keep up to date on any webinars and any social pushes. Again, thank you for attending and have a lovely afternoon.
Very much.
Bye.